I'm not really interested in something that's selling for $75 a share and is worth $100 a share. That is too Mickey Mouse for me. So what I'm looking for is it's selling for $75 a share and maybe it's worth 300 or 400 or 500 a share or more.
Hi Team Value, JJ here. Welcome back. Well, today we're going to look at more clips from Mohnish Pabrai. This time he's talking about being a shameless cloner, which doesn't just mean copying other investors. He talks about the process of investing, where to find investments, and much more. So let's get straight into it.
Yeah, so I think one of the problems in investing is that the data set is too large. We have 50,000 stocks around the planet. Each is a rabbit hole. And each rabbit hole that you might want to go down might take a few days to a few months to really get your arms around. A lot of these rabbit holes are not even in your circle of competence. So even if you went down them, you would not understand them. So there is a need to get some shortcuts and cut that data set down dramatically. One of the shortcuts you can use to cut that data set down is to be a shameless cloner. Don't just be a cloner, be a shameless cloner like me. So basically, if you have understood how some investors invest, how their minds work, etc., they usually have to make filings in various geographies around the world disclosing what they have. And they don't want to do that, but they have to do that. And so if you understand the investor, you see what kind of position they have, and you like the way they approach things and they have a good track record, well, that can cut your data set down by more than 99%. You might be able to take a 50,000 stock universe down to maybe 50 stocks or less, maybe 20 stocks, and then start going down those rabbit holes. So cloning can be a really good way to trim the data set, but you still have to do the work and you still have to figure out whether it's something that's within your circle of competence and whether you can understand the business well enough and whether there's a big delta between price and value once you've understood the business.
So that's a really good explanation, I think, of his concept of shameless cloning. When people hear it, they often think that you just copy an investor, you look at what they're investing in and you copy it, but obviously it's not like that. It has to be within your circle of competence, which Warren Buffett has talked about, the circle of competence. If you can't understand the business, then you're not going to make a good decision, or that you are far less likely to make a good investment decision. So he talks about going through Great Investors 13F filings there, and that's something that I do every quarter. I've made lots of videos about that. You can see super investor portfolios in my previous videos. It's a great thing to see every quarter, to go through these filings of investors that you respect. I'm looking for more of the smaller companies, small and mid-cap companies, rather than the huge companies. Some of these funds have such a lot of money, like Berkshire Hathaway, for example, that they have to invest in huge companies to be able to move the needle. But I like the smaller companies and mid-cap companies, and Mohnish Pabrai has invested in some of those too. And you can see what he's invested in, say his mutual fund and his main investment fund. You can see the things that he's chosen. Sometimes he says the things that he's taken from other investors, but the main thing is that he still says you have to do the work on it. You can get an idea of what other investors are investing in, but that doesn't mean you just copy it and buy an investment straight away without understanding it and analyzing it. So as he says, there are 50,000 companies or so around the world. He's not just talking in the US, he's talking around the world. So how do we choose from that? How do we cut the data set down? How do we make a short list, really, a very short list? And then within that short list, what's in our circle of competence is even smaller. So we get smaller and smaller, and even that's a lot of companies. And if you dive deep down the rabbit hole, as he talks about, then it can take weeks, months, days, depending on whatever it is, to discard it or to dive deeper and to eventually choose an investment. Now, if you're getting value out of this episode so far, I'd really appreciate it if you manage to hit that like button to help the algorithm to spread it to more people. It really does work. Thanks.
The very first question I ask myself when I run into some business, let's say I see some company on the 13F of some investor I admire, is the first question I ask, is it within my circle of competence? And a lot of businesses that wiped out when I asked that question. Now, if the business happens to be in my circle of competence, then I ask the second question, is it widely mispriced? I'm not really interested in something that's selling for $75 a share and is worth $100 a share. That is too Mickey Mouse for me, you know. So what I'm looking for is it's selling for $75 a share and maybe it's worth 300 or 400 or 500 a share or more. So the second question I ask myself is, does there appear to be a very large gap between price and value? And of course, you know, the world's a competitive place. So in most cases, for the second question, the answer is going to be no. But sometimes the answer might come out, yes, does appear to be a pretty large gap. And then I say, okay, let's go down the rabbit hole. And, you know, let's try to understand the business better and what it's about and what it's likely to look like in 5 or 10 years and, you know, what we might be able to make if you own it and so on. And so that's the process.
So he's looking for this big gap between price and value. And it's interesting to see his portfolio and the portfolios of other super investors after the quarter, because we can see what they've bought recently. And many, of course, are looking for something that's cheap as well as good quality. When he looks for compounders, he's looking for both, of course, which is kind of the holy grail of investing, this huge gap between price and value, and that it's going to compound over the long term, a huge runway for growth, very hard to find. Or if it's a more traditional value investment, it's, you know, the price is really cheap and the value is higher. So to get to fair value or above fair value, and it goes to there and you sell it, which can take, you know, anything from 1 to 5 years. And to think about how long you're prepared to wait. But if we look at Mohnish Pabrai's portfolio, especially the mutual fund, the new mutual fund, which I've made a video about, I'll probably make more about specific stocks or companies in that fund. But we can see that because he's bought them recently, and from what he said here, he obviously thinks that there is this big gap between price and value and that they're good quality, or some of them might be value plays. If we dive deep into each company, we can see it's possibly a long-term compounder, or if he's thinking of as a short-term value play. He does still do both, even though he talks about compounders more. He definitely, I can see he does still do both of those things. So, you know, there's good insight here into what to look for when you look at these 13F filings. Especially him is looking for this huge gap between price and value. He's talking about not getting that, you know, 10, 20, 30, even 40, 50%. It's not really worth it. He's looking for much more than that. And Lee Lu, great investor Lee Lu, has talked about this too. There's a video on YouTube of him talking at Columbia Business School quite a few years ago now, where he talks about this, some of his case studies where he looks for these huge gaps. He's looking for hundreds of % upside.
How do you start to sort of decide what rabbit hole to go down, knowing that some won't pan out and some will, but you can only choose so many?
Yeah, I think the way to do it, the way I've done it, is by being a harsh grader. So most companies I look at in 60 seconds or less, 10 seconds. There's whole, you know, sections of value line, which is outside circle of competence. I just take whole bunches and just not interested because like I don't know anything about biotech. I don't know anything about pharma. I don't know anything about a lot of things. So we just discard those. If something makes it past, you know, the first minute or first 2 minutes, I'll give it 5 or 10 minutes, right? And then again, the idea is to reject it and move on. So if it makes it past the 5 or 10 minutes, then we say, okay, let's give it an hour, see what's there for an hour. And so basically it's a gradual process where ideas, most of them die within 5 minutes. Then what's left dies within an hour. And then what's left dies within a few hours. And so once you've done a day or two of work, a lot of things have gone through your brain about, you know, it's still like, you know, Elton says, I'm still standing. The idea is still standing, you know. We can let a lot of balls go by and we only need to swing at the fat pitch. So if I looked at Google or maybe Microsoft 10 years ago, and even then felt that it was too rich in valuation, which would have been a mistake, and I took a pass, which is probably exactly what happened, it's not the end of the world. There's many, many more pitches coming at you. So it's okay.
So he's talking about fat pitches here, only swinging at the fat pitches. This is something that Charlie Munger talked about, waiting for that fat pitch, and Warren Buffett too. They're talking in terms of baseball, that, you know, in baseball you only get 3 strikes, but in investing you can get many strikes. You can just wait there and look at the ideas and discard them. As he said, very often it's easy to discard them in the first minute, and I find this too. You get an idea, there's so many ideas out there. I'm sure you see them all the time. And so if you're on X, on Twitter, on social media, you get ideas all the time. You can just look at them and say, well, that's not in my circle of competence. Or you can look at that if you've got financial software. I mean, I have GuruFocus and Ticker Terminal, use those two, and you can just look at them quickly and just see if anything catches your eye. So it's easy to dismiss them. Maybe something's got a huge amount of debt, for instance, or there's something else there that another investor might be okay with, and so it's easy to discard. Or many other reasons. It's in an industry where you just don't understand, so it's too technical or whatever. If you're from a background where you do understand it, you can dive deeper in there. But it's only those few fat pitches. Charlie Munger was famous for only swinging at pitches, only swinging big. Every so often he had so few stocks. Alibaba was one of those, of course, later on in his life, not long before he died. And he did say that it was one of his worst investments. Remains to be seen. We'll have to see. I've made a lot of videos about Alibaba if you want to go and see those. But I think it does remain to be seen whether that was one of his biggest mistakes. So even, the greatest investors can make mistakes. Warren Buffett's made many mistakes. So, Pabrai's talking about here, it's easy to discard things, many things. So you're just left with these very few that are good and quite often might have come from somewhere else, from another investor, shameless clone from another investor. And all but one of mine has. I just looked at my portfolio before thinking where that idea came from originally. And all but one came from somewhere else, from another great investor. But there were many others that I would have discarded along the way as well.
There's always a bear market somewhere. There's always opportunity somewhere. So if you broaden your horizons, you look at other geographies, you might find wide gaps between price and value, even though in those markets, there is incredible data available and incredible speed with which you can get that data and all of that. So Charlie used to always lament to me that we can't find anything to buy and blah, 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 like things are, so priced to perfection or overpriced and so on. That is true, but it's not true, for example, with car dealers. The large publicly traded car dealers trade at, mid-single digit multiples, for example. And of course, it depends on whether the differentiated view is correct or not, or whether they deserve to be at that multiple. I don't think it's so much data. I mean, I would say that it's more qualitative thinking versus quantitative data that is going to give you the edge. And so if you can qualitatively think through different businesses and industries and find some aha moment somewhere, which tells you that something is different here.
So here he's talking about where to find these ideas apart from the 13 Fs, this difference between price and value, the gap between price and value to look for. He said before this about the US market being expensive. If we look at, say, some of those AI names at the moment and other tech names, in 2022, they were way down from where they are now. So perhaps in 2022, that was a good place to look. And I do think it was in 2022 in that bear market where people were scared. But there are places to look in other countries as well. He talks about Turkey. He's been looking in Turkey for a few years. He's bought names in Turkey. Warren Buffett's bought these big companies in Japan recently, but very little in the US, but certain sectors in the US. Warren Buffett has looked at energy, and Mohnish Pabrai has been buying in the coal sector and car dealerships he's talked about. These could be bad decisions as well. We have to have a circle of competence, and he feels like he does in the coal sector. But he says there's always a bear market somewhere. There's always opportunity somewhere, even if things look expensive, to look for this gap between price and value. That's the important thing. In the stocks that I own, there's some from the US, there's some from Canada, some from Europe, Nordic countries. There's quite a wide spread there. So I've made sure that I've looked around the world and looked at what other investors have been investing in. So there's a widespread around the world. It's just not concentrated in one country, in one market. And if you want to see that, I do share that on my Patreon, the stocks that I'm buying, the stocks that I have, and I do discuss them from time to time. It's not investment advice, just what I'm doing. So I'll leave a link in the pinned comment in the description to that if you want to go and check that out. Now, what do you think of what Mohnish Pabrai said here? Do you think it's a good idea to look at what great investors are doing to narrow the pool like he says? Because there's so many stocks out there, where do we even start? What do you think of that? Do you agree with him, or you prefer to go it alone? Now, if you're watching this episode on YouTube, I'm going to put links here to previous Mohnish Pabrai episodes that I've made recently, so go and see one of those now if you haven't seen them already, if you want to, and I'll put them in the description for those watching or listening elsewhere also. Thanks to everybody for watching or listening, and I'll see you in the next one.